Hello and welcome to Follow the Money. I'm Robert Tan. Join us as we explore the tools and insights you need to jumpstart your financial journey. Today, we're diving into the art of building and preserving wealth, not just to make money, but to ensure it lasts for generations. We'll explore strategies to future-proof your income, multiply wealth beyond traditional investing, and design a personal economy that outlives you. And joining us to break this down is Ronald Agoncillo, founder of Exceed Supernova Financials Group. Good afternoon, Ronald. Welcome to the show.
Good afternoon, Robert.
Thanks for joining us.
Yes, my pleasure.
Ronald, let's start with this. Most people talk about making money, but few talk about outliving their money. Now, what's the first step in designing a personal economy that survives beyond one's lifetime?
Okay, let me answer that by, in the past decade or so, there has been a growing awareness on, because the term personal economy is very interesting because it puts you in a bigger context, which is how do you position yourself in the capitalist economy? And of course, obviously, a big part of the economy is consumerism or consumer or consumption, and other parts would be investing, asset building, and there was one proponent that I think started the whole thing. Not really started the whole thing, but he was quite successful in delivering this knowledge, which is Robert Kiyosaki.
Yes.
Yeah. Talking about Rich Dad, Poor Dad. It's basically a simple way of looking at where you want to be, in terms of your mindset in building your wealth, whether you climb the ladder or own the ladder.
Yes,
right?
Definitely.
So, but of course, majority, if not probably 80, 90% of people would be somewhere in climbing the ladder.
Yes.
But if you distill the idea, it's really talking about, are you an asset builder or a consumer? More of a consumer. But of course...
Or can you do both?
Or you can do both. Of course, it's always a good balance there, right? But I think the awareness on how rich people think in terms of building assets first is a good way of looking at your personal economy, meaning putting the horse before the carriage.
But usually that's quite hard when you say building, investing and building wealth first for those in the middle income bracket where the working class is mostly spending for the monthly expenses. They have hardly enough money left at the end of the month to invest. Now, when we talk about wealth, it's usually measured in numbers. Now, how should it also be measured in terms of influence, opportunity, and social capital?
Okay. As you mentioned, it has to have a good balance, right? Because in reality, whatever profession you are in or business you are in, there's a certain lifestyle that you need to have in order to sustain a certain level of influence. But I think more importantly is making sure that people around you are also taken care of. Meaning you need to help people to become successful, whether that's through training, through coaching, essentially making others look good as well.
Is it also part and parcel of building wealth, surrounding yourselves with the kind of people that have the same mindset in building wealth? Is that also part of that?
Oh, most definitely. There's a saying that you are the average income of the 5 people that you are surrounding
yourself with.
Yeah.
Now, what's the hidden danger now, Ronald, of those comfortable with those who are earning comfortable income? Now, how can that lead now to financial stagnation if somebody becomes too comfortable with what they're earning? Okay na to. I'm comfortable with. I don't want to go to that next level. Is that a bad thing of a mindset to have when you're trying to also build wealth?
Oh, okay. Traditionally, or people think of building wealth like as a linear path, no? You go into phases.
Yes.
No? You go to wealth, start accumulating, and then start thinking about preserving wealth, and then eventually, of course, starting to think how you distribute that to your heirs. But in reality, in most instances, those happen all at the same time. No? Even if you're accumulating wealth, there's no such thing as absolute preservation. If the wealth is either growing or diminishing, and primarily because of inflation, so you have to continuously think of ways on how to invest, and grow the value of your assets.
Now, you were mentioning about Robert Kiyosaki. He has in his book, there's 4 quadrants in terms of where someone is in that ladder. Can you, if you know a little bit about that, for those who are watching, how can they build wealth going up a ladder and to owning that ladder at the end of the day?
Okay, so if you look at those quadrants, it's in a way simple but yet complex. Okay, but essentially what he's saying is being smart on where to play in the economy, where you pay less taxes, you get all the favorable tax laws on your side, because one of the most heavily taxed wealth is income, right? So, but again, distilling it from a simple idea, it's just simple enough that you build a balance of building assets versus consuming things. No, when you say building assets, it's behavioral, Robert. So you have to be equally excited, or even so, say you buy a car versus, let's say, buying a bond. You have to be excited in a way that you're building your assets for your future.
Now, there are 2 schools of thought in terms of building assets. When you're mentioning buying a car, buying real estate. Where does that fall? When you buy a car, is that considered an asset, or is that considered something like an expense? Because when you buy a car, when you take it out of the showroom, that's already 20% depreciation. So where's that balance there where we know which are the assets that will help us build wealth and which are the assets that actually don't help us in terms of building wealth?
Okay, definitely car is part of consuming. You're consuming something, so it's not an asset. Assets, by definition, are things that either increase in value over time or you get additional income from. No? In fact, Robert Kiyosaki went as far as saying that investing in real estate for the long term, if it's not giving you cash flow because you're paying for taxes, upkeep, etc., it's not an asset, it's actually a liability. But of course, in the long term, it can be an asset. Right?
Now, in your experience, how can someone future-proof their income against industries that may disappear in, let's say, the next 10 to 20 years?
That's very interesting because we've been in the midst of these changes, no? But I think one good thing about what happened in the pandemic is we learned a very nice word, pivot.
Pivoting, yes.
Yeah, right? So people started pivoting, whether you're a professional, an employee, or a businessman, even multinational businesses started thinking of pivoting. But the thing with pivot is it's very nice because it means it's just an adjustment, right? So when industries eventually diminish or completely are gone, the trick is you just have to be always on your toes in a sense, that you keep yourself updated because changes normally happen, not that drastically, but you learn to pivot because whatever skills or resources that you've gained from that, even if the previous industry you were in was completely gone, chances are the skills that you have and the resources that you gained will do well in your next pivot.
Now, if we look at those, the new wealth generation economy right now, in terms of the advent of AI, the advent of crypto, are these 2 of the major things now that we actually should look into in terms of building wealth using these tools?
Yes. As long as there is a clear intention, because if you still look at it in a, let's say, a portfolio, crypto is still one of the highest risk, right? As long, it depends on your age. Of course, the younger you are, you can take more risk, probably have a bigger part of your portfolio there if that's something you feel is comfortable for you. AI is it's still in the early stage, but it's so powerful. But it's always
But it's kind of moving fast.
kind of moving fast. Yeah, it just takes a few months, and it's so different
So
already.
many changes.
Yeah.
And I think a lot of people now are using it, one, as a tool in helping them build more wealth by also cutting costs in terms of their companies, or if they're a startup entrepreneur, they can use these tools to elevate them to the next level. Now, how do you see this panning out in the next few years?
Okay. One of the things that we teach now, at least in our industry, is because there's a sort of a threat also on that. I mean, people can get financial advice now from an AI, and eventually that will become more sophisticated. But the thing is, financial advisory is quite personal. You need certain level of trust, no? So the best thing to do now is make sure you educate yourself on how to use your AI to your advantage, making things faster, and making your advisory process more efficient.
Now, when you advise also companies and individuals, right now, what is the most overlooked wealth multiplier that doesn't really involve traditional investing?
Oh, I may be super biased on this one. I've been in the industry, financial service industry for more than 2 decades. Obviously, for me, in my eyes, it's insurance.
Insurance.
It's very clear. Again, I'll refer back. Before and during the pandemic, there was a huge study in the U.S. There was strong interest on how the American royalty, the old rich of America, like the Vanderbilts, the Rockefellers, the Fords, and they found out that it's the Rockefellers who were able to maintain, in fact, grow their wealth exponentially. And lo and behold, they revealed that the main tool that you use is insurance, using the waterfall method. It's a simple concept. It's basically insuring everybody in the family. So, for example, the mother and the father is the first generation. For example, you insure them for 50 million each. So this means 100 million will go to the second generation. If they have 3 kids, they have spouses, that's 6 people, say 50 million each, that's 300 million. So that goes to the third generation, and so on and so forth. And the thing is, that is so powerful because each generation normally is bigger than the previous generation. So you can see the waterfall really growing and growing. And this information it's available. It's there in TikTok, in YouTube, in websites, but it is really overlooked.
Is that one way in terms of what we're discussing now in terms of outliving your wealth? Is insurance one of those tools or one of those financial tools that can actually help you do that?
Yes, definitely. Interesting about insurance is it covers all the 3 pillars of wealth management. You have wealth accumulation because there are variable insurances right now where it has investments in it. It is also a good tool for preservation because some of these investments actually pay out regular cash payouts. And most definitely the obvious one is distribution because there are certain efficiencies in terms of taxation that you can automatically transfer your wealth or distribute your wealth to your heirs.
Now, Ronald, we still have a lot to discuss, a lot of interesting things about building wealth and outliving it and putting it for the next generation. But we'll take a short break. Follow the money. We'll be right back. Welcome back to Follow the Money. We're still with Ronald Agoncillo, founder of Exceed Supernova Financials Group. Now, Ronald, we were talking about insurance as one of the tools. Do you think that when pandemic hit, people are now more aware about putting investments in insurance in terms of what we were discussing in not only building wealth, but outliving their wealth and putting it for the next generation?
Okay, unfortunately, yes, but more no.
More.
Yes, because a lot of people, took up a lot of health insurances during the pandemic and even after. But in terms of life insurance or wealth preservation insurances, it's still quite low, no? But the high net worth segment is quite more advanced because they were exposed to offshore advices, so they're more open to these types of products or solutions.
Now, Ronald, many people upgrade their lifestyle as soon as they earn more. Now, how can they design a lifestyle now that grows slower than the wealth without feeling deprived?
Okay. I mentioned earlier, these things is a lot of it is behavioral, mindset, right? So if you make yourself excited about acquiring an investment, then you don't feel so deprived, right? But of course, I would always refer to, just striking a balance, but have bias towards building assets. Because interestingly, there has been a survey with Gen Z, and majority of Gen Z globally would like to retire early.
Early.
Yeah, majority. So what the
Don't we all?
Yes, but they are the first generation who actually expressed it. Yeah, and they're very specific. 40s, retire by 40s, 50s. So what does that tell me? They have an awareness that they need to build assets in order to do that. So which means in terms of their behavior, they might have more an easier time on striking that balance if you have a goal there. Because if you want to do that, what you're essentially saying to yourself is, if this is my income, I'll save 60% of it and spend 40%. If you want to retire early.
But that's not as easy to do, especially now we always hear this YOLO life, this travel now, do the best because you don't know what's going to happen in the next 10 years. When we were younger, we were told, plan your life for 10 years, see that path. But now, do you see it's now different when you're talking about mindsetting, also in terms of trying to build wealth? Is that runway much shorter now?
I think it's in terms of available investments or assets for you to build wealth faster. I think the runway is actually shorter, but in a good way. You can actually build if you want to. No, on the YOLO mentality. For me, the survey is very telling. It means because Gen Zs think more of experience than it's more on the millennials who are more on the YOLO.
On the YOLO. So the Gen Z are more experiential, but also looking at investments.
Yes, because experience means a simple, can be a simple picnic. Experience is, simple life so that I can retire early and go around the world.
Not too extravagant.
Not too extravagant. Right.
Now, Ron, we were talking about wealth building again. Now, legacy planning often focuses on assets, as we discussed. Now, how do you ensure now that the values and financial discipline are also inherited by the next generation? Where, let's say, we're trying to build wealth so that the next generation can get that wealth and it outlives us. But now, how do we now transfer the discipline so that the next generation also builds wealth and it outlives them and it goes on generation? Hindi lang yung natatapos right there and it ends there.
Right. There are two aspects of that. It could be a very personal thing or it could even be an industrial thing. Personal, in a sense, it boils down to parenting. There has to be intentional parenting, teaching your kids about saving, about the value of money. But it's difficult for rich families to do that, really trying to discipline them. No, but And you've seen a lot of trust fund babies who have had problems on mental issues, no? But so it created also an additional service, no? Aside from your usual family office service, the family counseling is included in these packages.
Now, Ronald, what's one counterintuitive move today that can make someone wealthier over the next decade, even if it looks like a step back today?
Yeah, again, Robert, it's the same thing. It's really the change in mindset of being more excited about building assets than buying a certain thing.
Now, and finally, what's one wealth lesson you'd want to engrave on your headstone so that future generations would never forget it?
For me to simplify it, and hopefully people would understand, put the horse ahead of the carriage.
What do you mean by that?
So build assets first before elevating your lifestyle or increasing your consumption.
Okay, on that note, thank you very much. But we have this rapid fire questions just to get the ball rolling, so at least we find a little bit more about the wealth building part. Let's go. You just have to answer yes or no. You don't have to explain your answer, Ronald. If you had a time machine, would you go back and tell your younger self to save more money?
Yes.
Yeah. Okay. Is retiring at 25, no, sana all, just a fantasy for most of us mere mortals?
Yes.
Yes. Can avocado toast really ruin your chances of becoming a millionaire?
No.
No. Should we all secretly invest in crypto just to feel cool?
No.
No. And finally, Ronald, complete the sentence. Money is the root of all
joy.
joy. That's very good. We have different from our guests, some evil and the opportunity, but I like that. Money is the root of all joy, and I hope we all get to that point one day. Thank you, Ronald, for joining us here at Follow the Money. A lot of the insights. We've been educated also in terms of how we can build wealth and transfer it to the next generation. Thank you.
Thank you.
When it comes to building wealth and preserving wealth, some lessons are timeless. And as Robert Kiyosaki once said, it's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for. In today's economy, financial awareness goes beyond earning. It's about preserving wealth, making it work for you, and ensuring it lasts for generations. With insights on strategies like future-proofing income, multiplying wealth beyond traditional investing, and designing a personal economy that outlives you, this conversation touches every Filipino family. I'm Robert Tan. Stay curious, stay sharp, and always follow the money.